So let's talk about the Federal Reserve. It's this fascinating institution that has to do this incredible tightrope walk, managing the economy as it is right now, while also planning for what it's going to look like decades from now. And that's exactly what's happening. They're juggling the future of digital money with one hand, and with the other, they're dealing with the immediate risk of a weakening economy.
Okay, so to kick things off, let me ask you a question. What in the world do things like crypto, AI, and interest rates all have in common? I mean, they sound like they're from completely different planets, right? One is all about the future of tech, the other is classic, old-school central banking.
Well, it turns out the connection is a single person, Federal Reserve Governor Christopher Waller. He is smack in the middle of both of these massive conversations, simultaneously shaping the Fed's vision for the digital frontier, while also sounding the alarm on the economy of today. Talk about a full plate.
So let's start with that first piece, Waller's focus on the future. Because the Fed is looking way, way down the road, trying to get ready for a world where finance is going to look completely different.
Get this. On October 21st, the Fed is bringing together a bunch of experts for a huge conference all about the future of payments. And trust me, this isn't just some boring academic chat. They are literally laying the groundwork for how we're all going to be moving our money around in the years to come.
And if you look at the agenda, you can see just how seriously they're taking this. I mean, we're talking about everything from stablecoins and tokenizing real-world stuff to the big one, the convergence of traditional banking and decentralized finance. They're even diving into how AI is going to change transactions. This is the absolute cutting edge.
And Governor Waller himself is really championing this whole thing. He sees all this innovation as inevitable, and his goal is to get the people actually building this new future in a room to, as he puts it, examine the opportunities and challenges so they can make payments better and safer for all of us.
But you might be wondering, why is the Fed so deep in the weeds on this stuff? Well, it's because they are already a massive, massive player in the world of payments, which, brings us to our next section.
Yeah, this isn't some new side hustle for them. The reality is, the Federal Reserve is already a foundational piece of the entire U.S. payment system. They're not just some referee watching from the sidelines. They are an operator, deep in the trenches, moving money every single day.
Just to give you an idea of the scale we're talking about, their FedNow service, which is just one of their programs, already moves about $2.7 billion every single day. When you add in the older systems like FedWire and ACH, you start to realize they aren't just part of the system, they basically are the plumbing of the U.S. economy.
And Governor Waller has this really great, simple analogy to cut through all the jargon. He says, look, don't get freaked out by words like tokenization. He says buying crypto with a stablecoin is fundamentally the same as you swiping your debit card at the grocery store. Yeah, the tech is different, but the goal, a secure transaction between two people, is exactly the same.
Okay, so that's the future-gazing part. But at the exact same time all this is happening, Waller is intensely focused on a much more immediate problem. So let's pivot and talk about the here and now.
And here's the deal. Waller sees some really clear signs that the job market is starting to weaken. And for a Fed governor, that is a huge red flag. His solution? It's direct, it's urgent. He's saying the Fed needs to start cutting interest rates, and they need to start at the very next meeting.
And he's not just talking in generalities, he's actually laid out a potential path. He wants that first cut to happen as soon as September, and he's hinting that more could follow over the next 3 to 6 months. It's an aggressive timeline, and it shows he believes that if they act now, they can get inflation back down to that 2% goal within about half a year.
The numbers behind his argument really tell the story. The current policy rate is sitting well above 4%, but the estimated neutral rate, the rate that's not hitting the brakes or the gas, is probably closer to 3%. So, from Waller's point of view, we're basically driving with the emergency brake on. He's saying it's time to ease off before we do some real damage to the engine.
So, how do we make sense of these two things at once? One is all about embracing the future, taking risks, and innovating. The other is about being cautious and managing the economy right this second. They seem like total opposites.
But here's the most important takeaway. It's not a contradiction. Not at all. This is literally the Federal Reserve's job description in action. Their whole purpose, their dual mandate, is to make sure the financial system is healthy for the long run, while also managing the economy's short-term goals, like keeping people employed and prices stable.
So you can really picture Governor Waller fighting on two completely different fronts. On one front, he's looking to the future, exploring the innovation of digital assets. On the other, he's in the trenches of today, managing interest rates to protect the economy right now. They're two different jobs on two different timelines, and somehow they have to be managed at the same time.
And that leaves us with this one big question, right? Can a single institution, even one as powerful as the Fed, successfully be the architect of our financial future while at the same time steering the economy through the storms of today? It is the ultimate balancing act, and honestly, the answer is going to define what money looks like for all of us.